In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how the world's chocolate supply is now collapsing and what all of that says about our future with food and climate. And in the second story of the day, I'll talk about how SEBI uncovered a front-running scam that played out within seconds and what all of that also tells us about market abuse behind the scenes. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 14th of July. The world's biggest chocolate maker, Barry Callebaut, just made a major announcement. For the second time in this year, the company has slashed its sales forecast. And the reason is a massive cocoa crisis that is upending the entire chocolate industry. Now, if you're wondering what cocoa has to do with this in the first place, here is the thing. Cocoa is the raw material that is used to make chocolate, and Barry Callebaut processes nearly 2 million tons of it every single year. So the thing is, when they say that things are not looking good, it's not just about their own business, it is also a signal that something that is much bigger is going wrong with cocoa itself. Now, at the heart of this issue is a dramatic global shortage of cocoa. This is not a supply hiccup, don't get me wrong. It's the most serious cocoa crisis that the world has seen over the last 60 years. Basically, what began as a few weather-related issues in West Africa has now spiraled into something that is far worse, which is a full-blown supply shock that is hurting farmers, spiking chocolate prices, and making companies across the supply chain sort of panic. To give you a sense of the numbers, global cocoa production has dropped by 13% in the 2023-2024 season, falling to around 4.37 million tons. And while that may not sound like a very big number, it is a massive fall when you realize that global demand has stayed fairly steady. And as a result of this, there is now a gap of almost 500,000 tons between how much cocoa the world wants and how much it can actually get. And this 494,000 ton shortfall is the largest that we have seen ever since the 1960s. To put that into some amount of perspective for you, that is almost as if the entire annual cocoa production of Ecuador, which is the world's third largest cocoa producer, just completely vanished. Now, the biggest drop in output here has come from Ghana and the Ivory Coast, which are the two countries which grow around 60% of the world's cocoa. Ghana has had a terrible season where they produced only about 531,000 tons, which is much lower than its usual average of around 8 lakh tons. In fact, this has been Ghana's worst cocoa harvest in the last 15 long years. Ivory Coast as well saw a massive 20% fall in production, where its production dropped from its usual 2.25 million tons to just 1.8 million tons. And between these two countries, they have lost more cocoa than the entire size of the global deficit. And to make matters worse, there is also very little cocoa in reserve that we have right now. A key measure that is called the cocoa to stocks ratio, which basically tells us how many months of cocoa the market has as a buffer, shows that we have barely enough to last about 2 months. Now, to give you a point of reference, markets usually feel fairly stable when there is about 3 to 4 months of stock. So this is a very, very tight situation that we are in right now. And tight supply almost always leads to rising prices. Cocoa prices, as a result, have obviously skyrocketed. Futures contracts, which are basically the price that you agree to pay today for cocoa that you will buy later, has shot up to almost $13,000 per metric ton in December 2024. That is more than 4 times the typical price range of $2,000 to $3,000. At one point, a kg of cocoa was actually more valuable than many precious metals of the same weight. In fact, over the last 2 years, cocoa prices have outperformed almost every major commodity in the entire world. Gold prices rose by 25% this year, oil prices went up too, but cocoa has blown past both of them. At one point, its price rise even beat that of Nvidia, which is the poster child of the AI boom. So basically, from being an everyday ingredient in your chocolate bar, cocoa has all of a sudden turned into one of the hottest assets in global markets. But all that said and done, there might be some relief ahead. The International Cocoa Organization expects production to bounce back a little bit next year, up about 7.8%, while demand might actually fall about 4.8% because of high costs. Now that could of course bring things back into some level of balance. But again, prices are still expected to stay elevated. Most estimates suggest that cocoa will trade between $6,000 and $10,000 per ton in the near future, which is of course much higher than what we were used to. Now, Now, a good part in this is that some of the money is actually going into making cocoa more resilient. There is work underway to create cocoa varieties that can survive harsher conditions and also require lesser water to grow. The World Bank has also committed more than 227 million US dollars to help West African countries reduce their reliance on cocoa farming altogether and shift to other crops. But again, all of this is easier said than done, because at the core of this entire crisis is something that's much bigger, which is climate change. See, cocoa trees are incredibly sensitive to weather. The cacao tree, which basically gives us cocoa, needs a very narrow range of temperatures to survive and grow. To give you a sense, the ideal range is between 18 and 32 degrees Celsius. Anything colder means that the trees cannot grow well, and anything hotter means that the heat would start to hurt them. And that makes cacao one of the most climate sensitive crops in the whole wide world. And unfortunately, global warming is pushing large parts of the world beyond this comfort zone. In Ivory Coast and Ghana, the number of extremely hot days, which by the way are those above 32 degrees centigrade, is rising by about 40 days every single year. That is devastating for cocoa trees. It reduces yields, it lowers bean quality, and over time, it may even make large areas completely unsuitable for cocoa farming. In fact, estimates suggest that by 2050, global cocoa yields could fall by 20%. West Africa in itself could lose half of its cocoa growing regions if temperatures keep rising the way they are right now. But mind you, the problem is not just heat. Rainfall has also become more erratic. The last season, which is 2023-2024, was especially bad because of El Nino, which is a weather pattern that causes major shifts in rainfall. West Africa swung between extreme levels of rainfalls to long dry spells. In fact, in December 2023, the region saw more than double of its normal rainfall, but soon after that, there was a severe lack of rain. And this back and forth of too much water and too little water obviously throws the entire crop cycle off guards. On top of that, more rain followed by more heat creates the perfect environment for crop diseases as well. One such disease, which is called the black pod, thrives in humid, warm conditions, and it can sort of wipe off about 80% of a farmer's crop. Another one, which is called cacao swollen shoot virus, already affects about 20% of cocoa farms in the Ivory Coast, and it causes up to half the losses in Ghana. And in fact, because of all of this, Ghana is now running the world's largest disease eradication program to try and stop this virus from spreading further. But again, all that said and done, climate change is also not the only thing that is hurting cocoa. In Ghana, a different kind of crisis is playing out. It's called galamsey, which is the local word for illegal gold mining. See, farmers are now leasing their cocoa farms to illegal miners for quick money. But once a farm is actually mined for gold, the land is destroyed permanently. You just cannot grow cocoa there once again. In fact, to top it up, many cocoa plantations are just too old. Cocoa trees do not produce good yields forever, and after a certain age, they need to be replanted. But the problem is that replanting costs money, and many farmers simply do not have the funds or the willingness to do it. And to make matters even worse from here, even though global cocoa prices are touching record highs, farmers are still not making much money. Government price controls keep their earnings low. Fertilizer and input costs are high, so farmers have very little reason to actually invest in their farms or even replace aging trees. Some are even smuggling cocoa across borders to try and sell at better prices in other places. So young people are increasingly staying away from cocoa farming altogether. They see it as hard and low paying work that basically offers no future whatsoever. And all of this has created a perfect storm for cocoa. But again, this is not just a cocoa story. It's a part of a much bigger global concern. Cocoa is simply the most visible example of how climate change is starting to choke food production. Several of the world's most important crops are showing very similar warning signs. Let's take maize for example. This is the most widely grown grain in the entire world. It's highly sensitive to heat, so if the world keeps emitting greenhouse gases at high levels, maize yields could drop by 24% by the end of this century. And that would hit countries everywhere, right from the US to China and even India. And it's not even just that, wheat and rice, which are two basic crops that billions of people depend on, are also in big danger. India alone could see a 19% drop in wheat yields by as early as 2050 and a 40% drop by 2080. Rice yields in several parts of Asia, including India of course, could fall by 20% as early as mid-century. Soya beans are another critical crop, especially for protein. Their yields might fall by more than 11% globally, even under moderate warning. To give you a reference, for every about 1 degree centigrade rise in temperature, soya bean yields drop by about 4%. So when you add all all of this up, the picture becomes very bleak very quickly. The world's ability to produce food at scale is suddenly shrinking very quickly. Scientists are estimating that for every degree that the planet warms, we could lose about 554 trillion kilocalories in global food output. Hear that number again, we could lose 554 trillion kilocalories in global food output. That means on average, every person on the planet ends up missing 120 calories per day, which were calories that they were supposed to consume. And over time, that of course adds up. If the world warms by let's say 3 degrees centigrade, it would be equivalent of everyone skipping breakfast today every day. And if you think about this as a long-term situation, that's a very scary thought. So the cocoa crisis is simply the first major warning sign for us. It shows how climate change is already disrupting global supply chains, commodity prices, and food security. The burden of these disruptions is falling unequally. Small farmers, which are those people who grow the food, are facing the biggest risks, but they are also getting the smallest share of profits. And this imbalance is very dangerous. It could lead to more economic instability, more inequality, and in some regions, even social unrest. And in case you're still thinking climate change is a future problem, mind you, it is already here and it is very significantly changing the global economy one crop at a time. Whether we act fast enough to protect our food systems or not is the real question we now need to answer. That brings me to the end of the first story of the day. On that note, let's move on and talk about the second one. See, something very unusual happened with the stock trade in KPIT Technologies a few years ago. At first, it looked like a small, harmless profit-making move, which is the kind of trade that happens every day in the market. But when SEBI took a closer look here, they found something that was much more troubling underneath. What looked like a regular intraday trade turned out to be a textbook case of front running, which is a type of market abuse that regulators have been cracking down on more aggressively in recent times. So let me start with the very basics first. See, quickly, front running is when somebody trades on the stock market using confidential information that is not yet public. This is usually about a client's large order. Let's understand this with an example. See, suppose you know that a very big institution is going to buy a large chunk of a company's shares. Once that order goes through, the share price will likely go up. So if you buy before they do and you sell after the price rises, you naturally end up making a very big profit. And of course, the same logic applies in reverse as well. If you know they are going to sell a big amount, if you sell first and then buy again at a lower price once the price drops, you end up making a big profit once again. So the key point here is that the front runner is not really making a smart bet based on research or analysis. They are essentially using insider information that gives them an unfair advantage here. And that is what makes it illegal. And that's also what exactly SEBI says happened in KPIT Technologies' case. See, the trade happened on a single day, which is 26 July 2017. The company at the center of this was called Mehrangarh Financial Advisors Private Limited, or MFAPL. Now, on paper, MFAPL looked like a very small independent firm. But as SEBI later found out, it was not really independent at all. Behind the scenes, it was closely linked to brokerage Anand Rathi and was being used as a front, which is a shell company, to carry out trades that would not be traceable back to the real insiders. I'll tell you how it really unfolded. See, early in the morning before 10 o'clock, a major institutional client called Warhol Limited placed a large 100 crore rupees sell order for shares of KPIT Technologies. The order was placed through Anand Rathi, which is the brokerage. Now, anytime a large trade like this hits the market, it has the potential to move prices, obviously, right? So if someone else knows this trade was about to happen, they can try to take advantage of it. And that is exactly what MFAPL did. Between 10:13 and 11:10 a.m., NFAPL, which SEBI believes was just a proxy for insiders at Anand Rathi, began selling 5.52 lakh shares of KPIT. The average selling price was 123.73 rupees, but what is important to note here is that most of this selling happened after the Warhol trade had been confirmed internally at Anand Rathi, but before it was actually executed on the exchange. So MFAPL was able to sell at a higher price before the large sell order could bring the stock price down. Then came the clever part. At 11:11 a.m., MFAPL placed a buy order for the exact same quantity of shares, which is 5.52 lakhs, but this time at a much lower price of 120.20 rupees. Just 13 minutes later, at 11:24 and 6 seconds a.m., Warhol's sell order hit the market, and as expected, the share price fell. And exactly 2 seconds later, which is 11:24 and 8 seconds in the morning, MFAPL's buy order was matched. So So in less than 2 hours, they had sold high and bought low, making a neat intraday profit of 19.53 lakh rupees. Now I know, of course, about 19.5 lakh rupees might not sound like a massive scam on paper, especially when you compare it to large market scandals in India in the past. But the case is not just about the size of profit, it is about the way that this profit was made. It shows in real time how somebody with inside access can manipulate the market, not really by placing huge bets, but by just knowing something that others do not and acting on it just seconds before the rest of the world does. There's in fact another name for this kind of a pattern, which is called sell buy or SSB pattern. Basically, you sell shares at a high price before a big sell order hits the market, and then you buy back those shares at a lower price once the market reacts to the big order. Now, SEBI's allegation here is that MFAPL could have only executed this pattern so precisely because it had access to information that it was not supposed to have, especially that Warhol was about to sell a massive quantity of KPIT shares. Also, by the way, once SEBI started digging in, they found even more troubling connections. MFAPL, as it turns out, was not some random third-party firm. It was deeply, like I said, connected to Anand Rathi. All the money in MFAPL's trading account had actually come from the Anand Rathi group of companies. The phone number and email ID registered with the broker account were also linked to Anand Rathi employees. And the people who were authorized to operate MFAPL's accounts were themselves a part of Anand Rathi. And in 2018, which is just about a year after the trade, MFAPL was quietly merged into another Anand Rathi group company. So all of this led SEBI to conclude that MFAPL was just a shell entity used to carry out trades which Anand Rathi insiders could not do directly. There is one final twist though. We still do not know how SEBI found out about this trade. The order does not mention a whistleblower, a client complaint, or even an internal tip-off. To give you a sense of the timelines once again, the trade took place in July 2017. SEBI decided to investigate in March 2019, nearly 2 years later, and the investigating authority was formally appointed only in 2020. So it's very possible that the trade was actually picked up during a routine data analysis, and maybe the timing of the orders and the exact quantity matching raised some red flags here. But again, officially, SEBI has not disclosed what triggered this investigation. So in the end of this, SEBI fined MFAPL 40 lakh rupees and an additional 5 lakh rupees on its director Naresh Chandra Bora, who was listed as the official face of the company along with his mother. But again, the fine is almost besides the entire point that we are trying to make here. What this case really highlights is how insider trading access and timing, which could be down to the last second or millisecond for that matter, can be misused to rig the game in your favor, and how even a modest profit can expose an entire web of front entities and abuse of client trust. Now for SEBI, this is part of a broader cleanup effort. In recent months, they've been far more active in investigating fraudulent schemes, fake tips, influencer scams, and front-running cases like this. This one just happens to be one among the more well-documented examples where we get to see how the mechanics of a scam plays out minute by minute and trade by trade. It is basically a glimpse into how markets can be manipulated in broad daylight and why even seemingly small scams deserve some serious amount of attention. And that brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, we had recently looked into the fourth quarter of 2025 results of life insurance companies, but now we have some new data which could shed some light on how quarter 1 of 2026 results might look. See, India's life insurers clocked a 4.25% rise in new business premiums or NBP in the first quarter of 2026, which is a slowdown from last year's 23% jump post-regulatory changes. LIC grew premiums by 3.4% and its margin constraints continue thanks to heavy reliance on low margin participating policies. HDFC Life led private players with a 14.5% growth. SBI Life maintained margin discipline, but they posted just 3.3% growth, likely due to a shift away from low margin ULIPs. And ICICI Prudential's 6.5% growth hints that its pivot from ULIPs towards guaranteed products may be taking hold, but the impact on margins will be clearer in the coming quarters. Second, we recently spoken about how India's auto sector is facing the heat from China's rare earth export curbs. Now that heat is actually turning into some action. With magnet shipments still stuck at Chinese ports and Indian EV plants under stress, local players are scrambling for solutions. Mahindra & Mahindra and Uno Minda are now exploring local rare earth magnet production, which is a very important step towards self-reliance. The government as well is pushing for this shift. Incentives are reportedly in the works, and plans to build strategic stockpiles and expand domestic mining through IREL are gaining momentum. Third and the final one for the day, Hindustan Unilever has appointed Priya Nair as its new managing director and CEO effective 1st August. Nair, who's been with the company since 1995, currently leads Unilever's 13 billion euro beauty and well-being division and will succeed Rohit Java, who steps down after over 37 years with the company. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something interesting today. This is your host Anurag Bansal signing off. I'll see you in the next one. Take care and have a nice day. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.